Well, good afternoon, my fellow crypto traders. Today is Friday, August 26th, and it is currently 2:30 p.m. Eastern Standard Time. I wanted to bring you, before the close of Friday, this week's weekly update and talk about a few things here that I'm seeing on the charts. Of course, if you are subscribed at my website, which you should do, like and subscribe at my website to get all my notifications. You will see that about an hour ago I posted this classic head and shoulders pattern here on the 4-hour chart. We're going to talk a little bit about this, what it means for our markets, and really how it actually is not surprising, correlates with all the other data that I'm seeing, including what I'm seeing on the dollar chart, the VIX, oil, the inversion yield curve on the 10-year versus 2-year, the tightening of the banks, and also how that spills over into our crypto space. And we're going to talk a little bit about the USDT dominance and USDC dominance and what it means for our crypto space as well. So all of this sentiment, as always, spills over into the crypto space. At least so far it has. So let's get started here. I'm going to jump into the charts and we will talk a little bit about what we are seeing here on the charts and how the market is digesting this most recent press conference out of Jackson Hole by Jay Powell and the yours truly, the FOMC. All right, so anyways, this is the S&P. All right. Well, I'm graphing this on the SPY chart. You can see the same thing here over on the S&P chart. You can see on a 4-hour chart here. I might as well just graph this out so you guys can see it as we speak. A classic head and shoulders pattern, which we have broken the neckline of and are currently headed down to our target, which shall be, just one second, around 3,900. All right, that's where we're headed, and I believe the market can make it there, or at least closely make it. All right, now why do I say closely? Well, if I zoom out here, this is the 4-hour, I'm going to zoom back out to the daily. You can see this previous head and shoulders pattern was in play, and the market was fiercely headed down to the target, which was right around 350 on the SPY. Didn't quite get there. We hit strong support at 365. You see this? We hit it precisely. All right. And soon thereafter, we bounced up in this downward channel. We actually broke this strong area of confluence, which coincided with the 50-day moving average at the time, along with this level of resistance and the upper side of this descending channel. All right, so we broke through that. The bulls were strong enough to take us out of this channel, and we actually continued up and continued to break this neckline. All right, so that invalidates. That means the market is done following this pattern trajectory and has invalidated this whole head and shoulders pattern. We can safely now ignore that temporarily. In the longer term, I think the market is on a downward spiral. I'll talk about that in a bit, but I only have 20 minutes in this video, so there's not too much detail I can get into on each one of these scenarios. Really, the point of this chart here is I just wanted to show you what I am expecting currently from the market. I expect another 3 to 4% decline on the S&P, and that all correlates with the data we're seeing elsewhere. Now, I say 3 to 4% because I'm not quite sure that we'll break to the bottom side of this 100-day moving average, which is, you see I have the red circle around it, which is currently intersecting that neckline. So that's going to provide for the market a strong area of confluence, and I think we could see a bounce from there. All right, so that would be 3%. If we do break below that, we will go to this next level of support, which is at 394 on the SPY, 3,900 on the S&P. All right, so how does this data correlate with what I'm seeing on the dollar, VIX, and everything else? Let's take a look at that. All right, so you can remember I have been doing this M pattern here on the dollar chart for probably about 5 weeks now. I drew this when we had our first bullish descending wedge, and I said this looks like we could break to the upside again. Possibly, guys, it'll be a double top. And sure enough, here we are. We have formed a double top with the Fed's most recent comments out of Jackson Hole. It appears as if they are going to continue their rate hikes, and I don't know, it can be interpreted in different ways, but there was a 50-50 split between the next basis point hike being 50 points and or it being 75. Now, Jay Powell appeared to be, in my interpretation, a little bit more hawkish, so it is looking like it could be a possibility that we get that 75 basis point. That is currently what the market, I think, is trying to price in here. We don't know for sure yet. If that is the case, what we can expect is to break this 108 area resistance level and head right back up here to the 109 and really smash into that a little bit better. All right, we didn't quite touch it during the last up. You see this candle right here came short. All right. So possibly the market wants to just really make it up there and test that level of resistance before coming back down. And that would make sense with the 3 to 4% decline on the S&P. All right, so just that little bit along with the VIX moving up. I want to show you what I'm seeing on the VIX. The VIX here has this megaphone pattern. Now, where did that come from? Well, okay, so let's zoom out a little bit further here, and you can see I started drawing this trend line here back in October of last year. We hit it several times, 1, 2, 3, 4, and then we started a steeper incline on the VIX. Fear really spiked during that interval with the Ukraine-Russia war. And ever since then, we've been in this downward descending channel, which took us below this level of support. And then we broke above here, this channel. And now fear is spiking again. That takes us right into this bullish megaphone pattern. Bullish for the VIX means fear is going to continue to increase. And really what I do expect is that we've hit this level of resistance here at the 200-day once, and exactly as I predicted, hit our heads, came back down, tested support, and now in one day have come all the way up from support to hit our heads on that 200-day again. I think we can continue to expect fear to rise. All right, this is what this indicator is showing us at least. I don't know what event it would take for fear to continue to spike up, but the media has the keys to the kingdom with their narrative telling, and of course they can create a new fear campaign and start any number of fear campaigns to really spike this fear up. And when fear goes up, the market, fear along with the dollar going up, the market generally goes down. So that definitely correlates with what I'm seeing on the S&P 500 as well as the NASDAQ, all the indexes basically. You can see we have a head and shoulders pattern here on the NASDAQ as well. Target down here would be this level of support. All right, and what do we have on the Dow? I haven't even looked at it. Kind of the same thing right there. There's our head and shoulders pattern, classic, and we are coming down to probably this support here at 31,550. Maybe just the 50-day, who knows? Remains to be seen. I haven't really measured this out yet, so sorry guys. I just wanted to see if this all correlated, and it does. Now, what's happening with energy or U.S. oil? U.S. oil is really the predominant indicator of energy. All right, just as expected, we hit our heads on this 200 day moving average, came back down to support the bottom of our channel, now hit our heads on that again. I expect we're forming a bull flag here, and I expect energy will continue to increase. Now, why do I say that? Well, you have the Biden administration firing up the printing presses again, really, with this college payback program. First it was 10 grand, and now it's 20 grand for, I don't know, under 125K. And you can expect no less here in U.S. politics than the political administration to start to dole out the money and buy constituents. And that is exactly what is happening. And that's why it's really an easy game around the election time to predict what's going to happen. And we're going to have a little bit of a tug-o-war, really, between the Fed and the Biden administration is what's happening. So as the Biden administration continues to dole out dollars to the general public, that creates more inflation. All right. So when more inflation is created, Jay Powell has already said we're going to take care of inflation. So what's happening here is they are, they have a rope in the middle. And that rope is made out of U.S. taxpayers, U.S. citizens. And we are, they're pulling us back and forth, all right? The Biden administration doles out dollars, weakens the dollar, creates inflation. The Fed jacks up interest rates, tries to strengthen the dollar. And what is actually happening here, jumping over to another chart, is we have domestic banks tightening standards for commercial and industrial loans. Every time the Fed increases interest rates, it makes it harder and harder for the general public to take out a loan for cheap money. In other words, money is becoming more and more expensive to borrow. And this is really a lead indicator of a true recession. I know everybody says we're in a recession now. I don't think we're in a recession yet. Come on, guys. Let me zoom out here on this chart here. Let's go to the weekly. This is the S&P. All right. This is actually, let's go back to the SPY because that's got longer data. Okay. So this is where we used to be a little over 20 years ago. And this is where we are. This is our recession. I don't think so, guys. The recession is coming, but it's not here yet. Before we get that recession, I'm expecting we jump all the way up to this 550 level. Really, that sounds phenomenal. That sounds crazy to say, but the market is in for a fair amount of volatility with this tug-of-war between the Fed and the Biden administration. Though they look like they're on the same team, or they want to make it appear that way, it's not happening. The Fed has to continue to tighten interest rates to keep control of this inflation. And really all that's doing is that's spilling over and making it more and more difficult for banks to lend money and make profit. They have to continue to increase their rates, makes money more expensive to get, right? And that is a lead indicator for inflation/depression. All right, not to be too negative. Additionally, a big indicator has always happened. If I roll the S&P or any index on top of this chart, this is the U.S. 10-year yield versus the U.S. 2-year yield, and you can see the yield has become inverted. What that means is it's harder and harder for banks to make short-term loans for a profit. All right. And this has always been a lead indicator throughout history. Anytime the yield curve becomes, almost anytime the yield curve becomes inverted, you have major recession. And we haven't really seen in my lifetime a depression yet. Hopefully we won't. But you can see this here, lead indicator, all right, in 2000 already inverted, all right, and then we had our .com bubble burst over here in 2007. This was before the 2008 fallback. In fact, I could just Do I have time? Yeah, real quickly. No, I'm not going to do that. But you get the point. This came before recessions, this inverted yield curve. And look, guys, look where we are. We're way down here. We have not ever, except for 2007, leading into 2008, and way back here in 89. That was another big recession. All right, and we're right there again. All right, so this is a lead indicator of what's coming down the pipe. Not there yet, not a recession yet, but will be. All right, enough said on that. I covered oil, I believe. Did I cover oil? Oil is continuing up if I did not in this channel. And again, let's zoom out to the daily. Last video, you heard me talk about how we were going to hit our heads, come back down to the bottom. And then now we're currently forming a bullish flag. I don't know if I just covered, did I just say this? See, I had to do this video over. I can't remember what I said or not. Anyways, as energy prices go up, that creates difficulty in the economy as well. Oh, one more thing I wanted to show you here. This is the euro dollar futures. This is interesting because as this is a kind of a contraindicator here. So as the price goes up here, that's indicating a Fed softening. So far we have an inverse head and shoulders pattern here, which is indicating if we break this neckline and this price goes up, that indicates that the Fed will soften their stance on federal interest rate hikes. So it could be a 50 basis point hike. I don't know. It's just one conflicting data point that we have to observe and analyze. Okay, so what's happening down here in our crypto space? First, let's cover the dominance. All right, so you can see here we have a bullish descending wedge broken to the top side of that, formed a bull flag and continuing up. In other words, people are moving their money into stable coins. This is true as well for USDC. You can see clearly broken to the top side, bull flag, broken through the 50-day moving average, and we are moving up. Now, when people move their money into stable coins, it means that they are seeing a pullback, and we are definitely seeing the pullback. So over the next week, that's what these weekly updates are about, I do expect we should see a significant amount of pullback. All right, so on S&P, we already analyzed 3 to 4%. Now, what happens in the markets generally doubles in the Bitcoin space, all right? And what happens in the Bitcoin space generally doubles on the altcoin space. All right, so if we were to double 4%, let's say, of a pullback, and you can see right now we are currently on support, fighting that support, and it looks like we're going to break that support. So once that support breaks for Bitcoin, we have another 8%. That takes us right down here to exactly, almost exactly 19,000. All right, something like that. All right, actually 8%. 8% is 19,000. All right, from where we're at. All right, so that's if we go 8%. Now, if S&P only goes that 3%, like I'm anticipating, where it doesn't actually break below the 100-day again and the neckline, then we would go 6% on the crypto on Bitcoin, and that takes us to 20,000. All right, so 19 to 20,000 is what I'm expecting here over the next week for Bitcoin, good old Bitcoin. All right, and what happens in the Bitcoin space spills over into our altcoin space. So you could expect 12% pullback on most altcoins in that regards. All right, I'm coming to 19 minutes and 12 seconds. Let's do our outro and we'll be done with this weekly update. All right, so guys, if you find this content useful, please, please, please don't forget to like, comment, and subscribe. All right, every time you guys like my videos, or subscribe. Now, don't do it if you don't find it useful. But if you do find it useful, helpful in any ways, I would appreciate those likes and subscriptions. And it only helps me create more content like this for future viewers. If you don't want to miss any of my content, including free trade alerts to right now, all of my viewers, all of my subscribers, head on over to studam.us or studamus.com and subscribe there. You will not miss anything. Peace, y'all. I'll talk to you in the next video.